$50,000. That's what the average Kiwi under 50 is leaving on the table by staying in a balanced KiwiSaver fund. Same income, same employer contributions, same time frame. One decision switching to a growth or aggressive fund and you're ahead by 50 grand. Same age, different outcome. Here's what's actually happening right now. You're putting money into KiwiSaver every week, either your own cash or your employer's match. That money lands in whatever default fund you chose or got assigned to. For most people, that's the balanced fund. Sounds reasonable, right? Balanced, moderate, safe. Except it's not for you, not if you're under 50. A balanced KiwiSaver fund, we're talking the ones offered by SmartShares, Ants, BNZ, Westpac. They're sitting roughly 50% bonds, maybe 30% NZX equities and 20% international shares. That's the ballpark. Bonds right now are returning around 3.5% to 4% per year. NZX equities historically return 8% to 9%. You do the maths. You're in a fund where half your money is working at half the speed it could be. And you know what? That bond allocation makes sense if you're 62 and you need the money to be stable. You're not 62. If you're 35, you have 30 years until KiwiSaver opens. If you're 45, you've got 20 years. That's not a time frame for bond safety. That's a time frame for growth. Let me show you the actual dollar damage. The average Kiwi is contributing around $2,000 per month to KiwiSaver. That's a mix of employer contribution and voluntary savings. Most are getting the employer match too. So let's say the fund's getting topped up with $240 per month from their boss. That's $2,240 per month hitting the fund. In a balanced fund over 10 years, at 5.5% average annual return, which is honestly generous for a 50-50 bond equity mix, you end up with around $312,000. But if you switch that same $2,240 per month into a growth fund, at 7.5% annual return, which is realistic for a fund that's 70% equities, 30% bonds, you end up with around $365,000. Same contributions, same time, 13 years of difference. $50,000, that's the game. That's what most people don't see. But here's where it gets interesting. You're probably thinking, why haven't I switched? And honestly, most people don't because the system doesn't push you to. When you join KiwiSaver, you get handed a balanced fund. It feels stable. The name sounds safe. And unless you actively log in and change it, it just sits there, working at 5.5% instead of 7.5%, year after year after year. That's actually infuriating when you see what it adds up to over 20 years. Let's do the math for someone starting at 30. They've got 35 years until 65. They're putting $2,240 per month into KiwiSaver. In the balanced fund at 5.5%, they end up with around $1.80 million. In a growth fund at 7.5%, they end up with around $2.40 million. That's $600,000. That's the difference between retiring comfortably and retiring very comfortably. And the only difference is the fund you picked, the fund you can change today. And look, here's the thing. KiwiSaver funds charge fees. Most balanced funds are charging between 0.8% and 1.2% per year. That's eating into your returns before the 7.5% or 5.5% even happens. But growth funds, same fees basically, sometimes lower. So you're not losing returns to fees by switching. You're just moving to a better asset mix. Now, some of you are thinking about NZX Direct, buying shares straight onto the NZX instead of through a KiwiSaver fund. And honestly, if you're confident with it, that can work. A lot of Kiwis are doing this. But here's the reality. NZX trading costs money. Broker fees. Brokerage on buys and sells. If you're buying $500 worth of shares every month, those fees eat you alive. You'd need a brokerage fee below $5 per trade to make it worth it. And most brokers charge around $10 to $15. That's $120 to $180 per year, just in trading costs. Over 30 years, that's $3,600 to $5,400 in fees that KiwiSaver doesn't have. KiwiSaver growth funds, especially the diversified ones from providers like SmartShares or Kernel, they're buying the whole NZX and diversifying internationally. You get the upside of equities without trying to pick individual stocks. And the fees are lower because they're spreading costs across thousands of members. So here's what you actually do. Right now, not next month, now. First, log into your KiwiSaver account, wherever it is, Ants, BNZ, Westpac, SmartShares, whatever provider, you've got a dashboard. Look at your current fund. Check what it's actually invested in. Most of you will be in a balanced fund. You'll see the asset breakdown: bonds, NZX, equities, international. Second, check your age. If you're under 50, you should not be in a balanced fund. If you're under 40, you should be in growth. If you're under 30 and you're not in aggressive, you're leaving money on the table. These fund labels exist for a reason. Use them. Third, switch. That's it. Most providers let you switch funds once per quarter for free. Some let you do it monthly. Log in. Click switch fund. Choose growth or aggressive. Done. The money that's already in your account stays invested the whole time. It doesn't sit as cash while the switch happens. It just moves from one fund to another. You lose maybe 2 or 3 trading days of movement. That's it. The money you've already contributed, that's already gone to the old fund, right? That stays there. But every dollar that goes in from now on goes into the growth fund. And that's where the magic happens. $2,240 per month at 7.5% instead of 5.5%. That's an extra $48 per month that you're not earning right now. $48 per month. Sounds small. Over 20 years at 7.5% compound return, that $48 per month of difference becomes around $18,000 of extra wealth just from this year's contributions alone. Add in all the years, and you're back to that $50,000 figure, or the $100,000 if you're starting now and you've got 25 years to go. Here's the 90-day snowball. You switch your fund this week, nothing changes visibly. Your balance doesn't jump, but starting next month, your new contributions are working harder. In 3 months, you've made 3 additional contributions at the better rate. That's maybe an extra $144 in growth compared to the balanced fund. Doesn't sound like much, but it's compounding. By month 6, it's $300 ahead. By month 12, it's over $600. You're not doing anything, you just switched once. Now, one more thing. If you're self-employed or you're not getting employer contributions, the maths changes slightly. Your contributions are lower, but the percentage difference is the same. If you're putting $500 per month in yourself, you're still looking at losing $12,000 over 20 years by being in the wrong fund. Still worth switching. That's it. One decision, one login, one click. And the money that's been working at 5.5% starts working at 7.5%. The same KiwiSaver rules apply. You can't touch it until 65. But when you do, you've got 50 grand more than you would have had. You know what most people do when they see this number? Nothing. They think, oh, that's interesting, close the video and keep their money in the balanced fund. And their bank is absolutely counting on that. Because the more people who stay in the wrong fund, the more assets they manage at lower volatility, the easier their job is. They're not incentivized to tell you to switch. You have to do it yourself. Log in today, check your fund. If you're under 50 and you're in balanced, switch to growth. If you're under 40, switch to aggressive. That's your action, not next week, this week. $50,000 is waiting.